So today we've got $1 million client who wants to know how to convert the retirement savings into an income stream to supplement their pension and Social Security. They also want to know if it's going to be enough to last for the next 25 or 30 years. So let's jump into a planning session to take a look. So here we have our $1 million client, age 66 and 63, and we're going to start with a cash flow statement because I want you guys to see how their income and expenses work together. So moving over to reports, we want to look at income flows, and they're generating about $58,000 per year. Now, if we click on income flows, we can see each one of the income items. They have a small pension of $3,000 per year, rental income equal to $12,000, and then we have Social Security at about $43,000 per year for a total income flow of that $58,000. Now, moving back to the overview, if we take a look at their expenses, well, their expenses are a little higher than their income, quite a bit higher, at $83,000 per year. If we click on expenses, we can see those items. $62,000 for living expenses. That's everything excluding their mortgage. And the mortgage is about $20,000 per year and includes their property tax. It's impounded, so property tax and their insurance. They have a little tax paid, not a whole lot, because most of their income is either not taxable or that $25,000 or so, call it standard deduction, is really helping them out. Again, $83,000 per year all in on their expenses. Going back to cash flow, we want to look at their net annual cash flow, which is actually negative. So this is where a lot of clients have questions because they know that they're short. They can do a basic math. They can take a look and get estimates for their Social Security benefit and their pensions. They know what they're spending monthly, and they says, wait a second, we have a pretty big shortfall here. What are we going to do about it? That's where a retirement income planner like myself comes in to help. So $25,000 per year, call it $2,000 per month. They're short. Where is that going to come from? Well, I think it's pretty obvious that that's going to come from the retirement savings. The reason why you've saved for all these years is so that when you get to retirement, you can make up the difference between your Social Security and pensions, if you even have a pension. I think it's like 1 in 3 retirees have a pension nowadays. So the difference between those and your expenses. For this client, it's $2,000 a month or so, which is not terrible considering their assets. So this client needs to figure out how much as a percentage does $25,000 make up from that total portfolio, the retirement portfolio. And the reason we want to know what that looks like as a percentage is because then we can start to understand how much they need to generate off those assets in the market in order to have what we call capital preservation, or otherwise known as living off the interest. We have this great little tool in here or report called withdrawals, and it gives us the answer. So we can see here, if we take the $25,000 and divide it by their $1 million portfolio, they need to earn on an annual basis at minimum 2.61% in order to have capital preservation, to live off the interest. In other words, if they can maintain that percentage in the far right column, then that $1 million will stay level. Now, that number grows over time. You'll see that, and you might ask why. And there's a couple of different reasons. The first one is that taxes are increasing over time in the system. Another reason within taxes that come 2026, we have sunset, which means tax kind of rules will revert to what they were pre-Trump administration 2016. So taxes will be a little higher at that point. The other reason is because they're making, their assets continue to grow, and so they're required to take more from those assets via RMDs. So I'm not going to go into an explanation about RMDs, but that's the amount that you need to start taking per the IRS when you turn 72. For most people now, 72. If you haven't retired yet, for sure it's 72. And those assets, as they're growing, require you to take more and more as you age. So this percentage that they need to cover the shortfall, because their taxes are getting higher, is growing. Okay, so but it's not terrible, and even all the way down until about the age of well, we're planning till about age 100 here, it starts to get to about 6%, which is still achievable for a retiree. And so that's one number you really want to pay attention to. So what I'm going to do now is go back to cash flow and talk to you guys about what this client can do in order to cover that shortfall, that $25,000 per year, because right now they don't have it. Even though it's hidden away and we're going to take it from, they have it in the retirement accounts, they don't currently have a plan in place to make withdrawals from those retirement accounts in a productive fashion in order to cover that shortfall. So let's jump to that next. So before moving into the next section, let's do a quick recap. You guys learned that the client's expenses are greater than their income, and that produced an annual shortfall of about $25,000. It's about $2,000 per month, we'll call it. Now, we know that's got to come from the retirement savings, and that against the retirement savings, it's about 3 to 5% per year. It's lower in the beginning and it's higher later on because of taxes. And so the question then becomes, how do we take the retirement savings into a place where the client is not taking on too much risk? We want to be conservative, because if the market takes big hits, well, the client runs the danger of running out of money during retirement. But we also need the account to earn enough interest every year to hit that 3 to 5% target. So I'm going to jump into a planning session where we talk high level about what type of investments we built out for the client in order to achieve that goal. All right, so looking back at the cash flow statement, I've gone ahead and updated the plan to a different scenario, one where we have gone ahead and created systematic withdrawals or distributions from the retirement savings accounts in order to cover their shortfall. And we see that in this column called planned distributions, $32,200 per year. Now their total income for the year is $90,000. It lifts their expenses up slightly because they'll pay a little more tax, but they've got enough income to cover those expenses, and we can see that their net cash flow is positive. Whereas before it was negative $25,000, it is now positive, just slightly under $1,000, and growing every year thereafter. Now what I want to do is click on plan distributions so you guys can see the type of accounts we've set up for the client in order to make those distributions. So in the first column we have, it's the third column, but the first distribution is coming from a Charles Schwab IRA. So the client had a 401k. We rolled that 401k over tax-free into a Charles Schwab IRA. And we can talk about the difference between 401ks and IRAs. Typically, an IRA has more options available, so you can hit diversification, which is the number one rule to investing. In the second column, we have Gillico. This is an annuity, a fixed indexed annuity. And we also have a fixed indexed annuity with Lincoln Financial. And we are taking income from the three of those in order to make up the client's shortfall. Now, Charles Schwab is an equity portfolio. So when you talk about how a portfolio should be constructed, the old rule of thumb is your current age minus 100, and you split that between stocks and bonds. So 60% or so of their portfolio we have allocated to Charles Schwab, and in that account it's all equities. Now I'm not going to walk through what stocks we have chosen, hand selected for the client. We can get into that on another discussion in another video series, but know that that portfolio is predominantly comprised of equities. Now the other two, and I should say three, there's security benefit. It just so happens we're not taking income from security benefit until they hit their RMDs. They're forced to take income from that account. These three other types are the same type, fixed indexed annuities. And why did we choose fixed indexed annuities when typically you would see bonds in the client's portfolio to make up that 40%? And the reason is because interest rates are rising. That is the biggest reason. And what do I mean by it? Why don't bonds perform well during higher interest rate environments? And I should say while bond rates or rates in general are increasing. And that is because if you were to buy a 2% bond today and a 3% bond came out tomorrow, investors will gravitate towards the 3% bond. In order to compete with that 3% bond, you will need to discount the value of your bond. And that is why bonds lose value as interest rates are rising. So to offset that, we have purchased fixed indexed annuities because they are not susceptible to that same risk. They work a little bit more like the stock market. There's a lot of disclosure there, so I'm not going to get into the details, but we have found that they are not as affected by interest rates, but they also will produce the 4 to 6% we need out of a bond portfolio. So together, these two combined, this is probably closer to a 50-50 split between what we would call an equity portfolio and an fixed income portfolio. But you can see that those are the type of investments that we have selected for the client. And all we have done is used a weighted average to take withdrawals from each one of these accounts. And what I mean by that is the bigger account will take more from the bigger account and we'll take less from the smaller accounts. We'll do it as what we call weighted. So we've got 10,000 coming from Schwab, 12,000 from Gillico, Lincoln 10,200, and those three combined is the $32,200 the client needs in order to cover their shortfall. Again, later on down the road, they'll start receiving they'll start income from their security benefit account. That's because of RMDs. And it just turns out that the other three columns do rise slightly. We're seeing it in Charles Schwab and Gillico more than Lincoln Financial. And that's because at the age 72, the IRS requires you start making withdrawals from your retirement savings. And it starts at about 4% per year to slightly under. And that just so happens that we're taking about that percent from these accounts. So at that time, Charles Schwab, not exactly 4, so it does rise quite a bit, but we are taking about 4% or so from Gillico. So it's not much of a difference there. And the same could be said for Lincoln. And then we have that new stream of income coming from security benefit. So that is how we solved this client's annual shortfall. We split the monies up, we diversified across a series of different investment types, and then in Schwab and the three others, we do have diversified across a series of different stocks and bonds. So we didn't take a lot of time to talk about the individual stocks and bonds we chose within each of those retirement vehicles. That's not the big takeaway. The big takeaway is that if you get to retirement and have a shortfall, that you're going to need to restructure your portfolio to be more conservative in nature. What we typically recommend is a split, 50-50, 60-40. You can use the 100 minus your current age rule of thumb. Whatever it is, you want to find yourself in more of a conservative type portfolio that you'll take your distribution from. The reason you want to be more conservative when you get to retirement with your investments is because you can't take the hits you could when you were younger. When you were younger, your wages were used to cover your expenses. And so you could take all the risk in the world in your investment accounts because you were not dependent upon them. However, when you get to retirement, that's not the case. You are now dependent upon, as you saw in the plan, $2,000 a month for this client coming off of those assets. So you need to make sure that the volatility, that the swings of up and downs are more level in retirement than they were when you were younger. We so happen to use a 60-40 blend for this client. And fixed indexed annuities more so for the bonds as a bond proxy or alternative, we call it, because bonds are currently, rates are on the rise, so bonds are losing value. And so hopefully you guys took a couple of things away from today's session. If you need help restructuring your portfolio for retirement, please don't hesitate to reach out to us. And thank you guys so much for taking the time to tune in today.